Okay, in this video we're going to continue looking at ratios, and in particular we'll look at profitability ratios to start with. Basically looking at how much money the firm is making, how well they're turning sales into income, how well they're turning or using their assets to generate income, etc. So let's take a look at each of these in turn. The net profit margin is defined as net income divided by sales. So we're looking at the bottom line after taxes have been taken out, after everything has been taken out, what you have at the end of the day. And that as a percentage of sales tells you the net profit margin. The operating profit margin is a little bit different. It's the EBIT, or the operating income, divided by sales. So now we're not taking into account the interest or taxes that a firm pays. So we're looking more at how well they're able to turn operations into, or how well they're able to make money off of their operations. Basic earning power looks to how well the firm is utilizing its assets. So in a sense, it's related to some of those asset management ratios and how effectively the firm is doing it. But now we're looking at EBIT, so we're looking at a profitability measure. Again, earnings before interest and taxes is that operating profit number. And then two very common ones that are looked at: return on assets and return on equity. Both of those are net income in the numerator, and then the denominator is gonna vary. So return on assets has total assets in the denominator. Return on equity just has the equity number in the denominator. And these are all relatively simple to calculate, to get from the income statement and the balance sheet. So I'm not going to go back to Excel for these and calculate them, just in the interest of time. And we'll keep moving on to the next set of ratios, the market value measures. These give some information about the company, in particular looking at the stock market performance. So in a sense, it's how well the stock market, the people who are buying and selling shares, how well they like the firm, what it's doing, and it's some measure of how the firm is performing in the stock market. So we'll look at four different ones here. The PE ratio is a very simple one. It's the price per share divided by the earnings per share. It's a kind of a very common metric, talked about a lot. Sometimes it gives you a sense of how a firm is performing over time, or at least how the market is perceiving it over time. Sometimes you can look at the trend in PE ratios and see kind of what the market thinks about the firm and its performance. Price to cash flow is another measure. We're not going to get into this one, I don't think, at all in the class, but it's the price per share divided by the cash flow per share. The price to sales ratio is not a particularly common ratio. Sometimes it's used particularly for younger companies. Maybe they don't have earnings yet or a lot of cash flow yet, but we can look at the sales and get some sense of valuation and compare it to other firms. So it's just the price per share divided by the sales per share. And finally, the market to book ratio looks at how highly the market thinks of a firm. The more they're willing to pay for those firms' earnings, the more value that the market places on the firm, the higher this number will be. So it's defined as the share price divided by the book value per share. So or another way of saying that is the total equity per share. The higher that number is, again, it's an indication that the better the managers are able to use the assets that they have in place to generate income and generate earnings. And also, there's another kind of flavor to this market to book ratio. It gets the idea of the future prospects. The market thinks, and is kind of voting with their dollars, that this firm is able to continue to do well, to perform well into the future. So the higher the market to book, generally the better the prospects are going forward. Let's move on to standardized financial statements. I do want to show you some of these calculations. So we'll maybe end this fourth video with looking at common size income statements and common size financial statements. But common size statements are a very nice tool, a very useful tool, and they can help us compare across firms and also compare a given firm across years. And it makes it very easy to do this. So when we scale things, it takes away some of the problems of comparing firms that are kind of growing rapidly. Instead of just looking at big numbers we can look at relationships, and it helps us maybe see what's going on. And we can see this in an example here in a few minutes. But first, let's talk about the two different pieces, the common size balance sheet and the common size income statement. In the common size balance sheet, what we're going to do is scale every item, every line item, by the total assets. So in any given year, that's what we're going to do. And so for each year, we'll take the line items in that particular year divided by the total assets in that year, and we end up with all of the items described as a percentage of total assets. Common size income statement, now we're going to scale everything by total revenues or sales, and it's going to show all of our line items as a percentage of sales. So let's go again to the spreadsheet and take a look at an example of that. So I've got that at the top part of the comparison sheet, some common size templates set up here. So let's do the income statement first. And what we're going to do with the common size income statement is divide every line item by total revenues. And so we're going to go to the income statement for Home Depot. I'm going to take revenue and divide it by revenue, total revenue. By the way, I'm going to hit the F4 key now. It's a very important key in Excel. It locks the cell reference. So when I lock this, everything is going to be divided by cell B2. And actually, I want to not lock it to this absolutely, or just this one cell. I want to lock it to this row. So I'm going to do that by locking onto the second row. With the dollar sign in front of the 2, that means everything is going to be divided by a number in the second row. The common size number for sales, by definition, is going to be 1. So when we divide revenue by revenue, we're going to get that equal to 1. But if I copy this down, this is where it starts to become a little more handy. I can see that my cost of revenue, or the cost of goods, in 2006 was 66% of sales. And my gross profits were the residual, so 33.6% of sales went to the gross profit number. Now, let's just real quickly copy this across time. The revenue is always going to stay 1. It's always 100% of itself. But we can see that the cost of goods sold is kind of decreasing over time. Actually, every year it looks like it's getting slightly smaller. And that paints a nice picture for Home Depot. Their cost of goods sold is going down. The gross profit margin is increasing each year. It increases about 1.2% over the 8 years in this analysis, and that's a good thing. That paints a good picture, and it helps us see that the profit margin is going up even much better than if we just look at the income statement. Now the dollars are kind of bouncing up and down here, right? They go from $26.5 billion down to $22 billion, and then back up to $27 billion. But we don't really get a sense of the margins or the relationships to sales, because sales plummeted during the recession, and we might want to ask the question: were they able to turn those more meager sales into profits? And so the common size thing takes away the changes, the fluctuations in the absolute numbers, and we can look at the relationships and a lot of times get a much better sense of what's happening with the company. All right, let's continue to copy this formula down. If I copy that down to the selling general administrative, I see that in 2006 that was 20% of sales. We would like to control that cost, so we don't want to see these costs increasing substantially over time. In this case, the SG&A expenses have increased. They really ballooned during the recession up to 24 and 25%. But they're on their way back down, which is a good thing. That means we're getting a little bit better handle, a little bit more control over those expenses. And let me just go ahead and copy all of these. The very bottom line, the 7.073 there, or 7.3 cents per dollar, that's the net profit margin we talked about in the profitability ratios. So the firm is making 7.3 cents for every dollar in sales. And again, we'd like to see that growing over time. And we can now quickly look and see how that changed for the firm. The profitability went down. The profit margin, I should say, went down quite a bit during the recession, and it's on its way back up. It hasn't quite recovered to the to 2006 margins, but we're getting closer, and we might expect in 2014 that we'll be there. So that is the common size income statement. By the way, I should point out that a lot of times, instead of these being, so for instance, the net income number, instead of it showing up as 0.073, a lot of times it'll show up as just 7.3. So it'd be as if we took all of these numbers here and multiply them by 100. That's frequently how common size numbers will show up. So the operating income, for instance, in 2006, the common size number for operating income might be reported as 11.2. And the interpretation is always that that's a percentage. It's 11.2% of sales. So that's the common size income statement. Let's go down to the common size balance sheet. And here again, we're going to take everything and we're going to divide it. We're going to scale it by a number. And in this case, the number is going to be the total assets. So we're going to go back to the balance sheet now. I'm going to take the very first number, cash and cash equivalents, divide that by total assets here. I'm going to hit the F4 key twice to toggle to where it's going to keep that that row as the reference, or the absolute reference. So it'll always be dividing by things on the total asset row, and that's what I want. So this says that cash and cash equivalents are about 1.8% of total assets. And if I look at the trend over time, I can see that the firm has been generally increasing their cash as a percentage of assets. So as a percentage of the total asset pie, they're holding a little bit more cash over time. And again, I'm just going to copy this formula, or these formulas, all the way down, and we can maybe highlight a few things that jump out. Well, we've already actually looked at some of these in the leverage ratios, and this just shows us that their use of leverage has been increasing over time. We can see that very clearly from the common size balance sheet, even if we weren't calculating those ratios earlier. A consistent or something in the same kind of vein, the equity as a percentage of total assets, we can see that decreasing. That's kind of, again, the flip side of the coin from the leverage going up or the debt going up, is that equity as a percentage of assets is going to be decreasing. But the common size statements are very handy, and they are very helpful to kind of see trends across time. And it highlights the relationships between numbers. So we're going to stop there, and we'll finish up the ratio analysis in the next video.